You've likely seen the headlines. OpenAI launched Sora 2, its newest, most advanced video generator, only for user retention to plummet to just 1% in 30 days. But that's merely the beginning. A strange phenomenon is unfolding in the world of artificial intelligence, and it could reveal a surprising truth about its future. After Microsoft announced massive AI expenditures, its market cap astonishingly dropped by $360 billion in a single day. CEOs are now publicly urging people to temper their negativity. Why are users abandoning AI tools at an increasing rate? Is this colossal experiment finally on the verge of collapse? Back in January 2026, Microsoft CEO Satya Nadella stated, "For this not to be a bubble by definition, it requires that the benefits of this are much more evenly spread." A telltale sign of if it's a bubble would be if only tech groups were benefiting from the rise of AI, rather than companies in other sectors. He also requested that people stop referring to AI as slop. These are peculiar statements from someone who has invested $200 billion since 2024. Jensen Huang, the CEO of Nvidia, echoes similar sentiments, expressing concern about the doomer narrative, end-of-the-world narrative, science fiction narrative, painted by well-respected individuals. He believes such portrayals are unhelpful to people, the industry, society, and governments. So, why do the leaders of the AI revolution suddenly appear so insecure about its prospects? The situation gets even stranger. If you've been monitoring big tech recently, you might have noticed Nvidia's stock has largely moved sideways for several months. Other AI-focused companies have experienced significant downturns, such as Oracle, whose stock has fallen over 50% in the last 5 months after peaking with its major OpenAI deal. Perhaps the most perplexing example comes from Microsoft's recent earnings report. Despite Azure Cloud growing by 39% and revenue increasing 17% to $81 billion this quarter alone, both exceeding expectations, Microsoft's market cap plunged by $360 billion in a single day following the announcement. Within a week, the total loss exceeded $500 billion. The reason? Capital expenditure was up an astounding 66%, with $37.5 billion spent in just one quarter, 2/3 of which was allocated to chips, GPUs, and CPUs for AI development. It appears investors are growing increasingly wary of this AI money pit. As portfolio manager Eric Clark noted, one big obvious issue is that revenues are up 17% and the cost of revenues are up 19%. So if that is a new long-term trend, that is one of my concerns. The outcomes of Microsoft's extensive AI projects are proving to be remarkably confusing. Following Microsoft's report, Oracle announced a plan to spend $50 billion on AI by 2026, only to see its stock fall further. Investors are clearly growing cautious about the escalating costs of Oracle's AI ambitions and the prolonged timeline for seeing a return. Compounding these concerns is Nvidia. Last year, their initial plan was to invest up to $100 billion in OpenAI. However, Huang recently walked back this commitment, stating it was nothing of the sort and that the agreement was non-binding and not finalized. OpenAI is a massive customer for these tech giants, which is why they pour billions into it. Yet, OpenAI itself is not profitable. According to the Wall Street Journal, Huang has privately criticized what he has described as a lack of discipline in OpenAI's business approach and expressed concern about the competition it faces from the likes of Google and Anthropic. While OpenAI's revenue surpassed $20 billion in 2025, a $6 billion increase from 2024, its total cash flow projection is a staggering negative $143 billion. The company doesn't anticipate profitability until 2030 and could run out of funds by 2027. Essentially, these are OpenAI's suppliers funneling money into their biggest customer, which then cycles back to them for cloud services, GPUs, and other resources necessary to keep ChatGPT operational. Amazon, Nvidia, and Microsoft are discussing investing $60 billion into OpenAI, but even this substantial sum may be barely enough to sustain a monster with an insatiable appetite. This entire system is starting to falter, and it's not just investors who are concerned. Senator Elizabeth Warren highlighted that OpenAI has committed to more than $1 trillion in spending despite not yet turning a profit, and appears to be seeking government assistance should it prove unable to pay its bills. Ironically, this is an issue that both Democrats and Republicans seem to agree on. The government is reluctant to bail out a startup requiring unlimited funding. OpenAI has denied seeking a bailout, though confidence wasn't bolstered when their CFO suggested taxpayers should backstop the company's hefty infrastructure investments, a statement she quickly retracted. Beyond these financial woes, OpenAI, Microsoft, and Nvidia face another, even larger problem that is causing investors to question the entire AI gamble. Consider the data. Searches for AI have peaked and subsequently declined significantly. Does this indicate the demise of AI? Not quite. It reveals something more profound. When a new technology emerges, interest surges, peaks, and then settles into a new normal. This pattern is not new, it's known as the Gartner hype cycle. Late last year, the value philosopher published a compelling article titled "The End of AI Tourism," which perfectly explains why Sora saw 99% of its users disappear. Suno, the AI music company, reportedly scraped millions of copyrighted tracks for its AI music generator, attracting 10 million users, most of whom later left. Now, the company is attempting to rebrand itself as a tool for real artists to win them back. A similar trajectory was observed with Sora. In its first 3 days, it surpassed even ChatGPT's initial growth. However, user retention plummeted to 2% by day 7, 1% by day 30, and nearly 0% by day 60. The most valuable private company's flagship new product has virtually no active users. This phenomenon is the tourism effect. An AI tourist arrives, generates 50 images of a cat in a spacesuit, and gets their dopamine hit. After a week, they realize the 100th image brings no joy. The result holds no value because there is no effort or story behind it. And what does a user do when an app stops being fun? They cancel the subscription. AI-generated videos and photos once captivated audiences, but now they're, frankly, somewhat mundane. This is the core issue with many AI products. From an investment perspective, we must shift from asking, who has the better AI, to, who has the better product. AI excels as a feature that enhances an existing profession, tool, or platform, such as coding, science, radiology, administration, or image editing. Adobe, for instance, after its initial AI controversies, has achieved considerable success not by offering AI as a standalone product, but by integrating generative AI functions into its existing tools, thereby supplementing, rather than replacing, them. This strategy explains why ChatGPT is currently struggling, while Google Gemini is experiencing explosive growth. Google already manages our emails, documents, spreadsheets, calendars, YouTube, and Drive. The moment Gemini seamlessly interconnects this vast ecosystem, the competitive landscape fundamentally changes. Microsoft is also recognizing this reality. They reported 15 million paid Microsoft 365 Copilot seats, which sounds substantial. However, this represents only about 3% of their 450 million Microsoft 365 user base. A mere 3% for tens of billions spent quarterly. Microsoft is privately aware of this challenge, which is why they incentivized customers toward the Copilot version of 365 while downplaying the cheaper, Classic plan, even rebranding 365 as Copilot 365 after initial low adoption rates. This isn't just a consumer issue. Over half of CEOs surveyed by PwC last month reported no revenue or cost gains from AI. As we descend into this trough of disillusionment, the enormous cost of generative AI remains a critical factor. With such immense spending, AI cannot simply be a niche product for a handful of users. Joe Wilkins from Futurism articulates this well: with so much money riding on AI, anything less than a complete upheaval of the world as we know it will look like a failure. A typical financial analysis indicates that the top 7 big tech companies should be seeing an extra $600 billion in yearly revenue. To put that in perspective, Walmart, the highest revenue company globally, generates approximately $600 billion annually. Nadella's quote resonates once more: for this not to be a bubble, it requires that the benefits of this are much more evenly spread. AI is incredibly expensive, and these companies have invested so heavily that it simply cannot remain a niche application. This brings us to what I believe is the true path to survival for AI. Is there a scenario where the bubble bursts and AI vanishes entirely? I highly doubt it. However, I agree with something Jensen Huang once said: rather than transforming the entire world, AI has delivered quantum leaps in specific, individual domains. AI has enabled breakthroughs in predicting protein structures, drastically accelerating the discovery of new medicines. It's improving early detection of breast cancer and allowing for faster forecasting of weather, floods, and storms. AI is even being used to decipher the alphabet and language of whales. Anthropic's AI assisted NASA with the Martian rover. When AI empowers professionals to perform their jobs more effectively, it represents a genuinely valuable application. Unfortunately, many CEOs initially viewed AI primarily as a means to reduce costs and, consequently, reduce their workforce. For these companies to achieve a real return on their investment, the hype curve needs to stabilize and mature. We currently observe two distinct approaches to AI. One posits that it will fundamentally alter the world, ushering in a post-work utopia where every industry undergoes radical transformation. The other, more grounded perspective, suggests that these products will simply help us achieve more, but without entirely replacing human labor. As one investor put it, I am now avoiding companies that bet on AI tourists, users seeking dopamine and entertainment. This is precisely why I appreciate Anthropic's approach. They focus on assisting programmers and tackling the more boring but essential tasks. I believe the established, incumbent players will ultimately thrive. These are companies with strong brands, existing infrastructure, and, most crucially, massive user bases deeply integrated into their ecosystems through their work. For companies like Adobe or Google, AI is not the product itself, but rather, just another feature that makes their already indispensable products even more powerful. I contend that a bubble bursting would actually be beneficial for the future of AI, as it seems people are beginning to adopt a more sensible outlook. Of course, this could merely be a temporary dip, and these companies might yet convince investors of a new, massive wave of returns, driving market caps even higher. Perhaps. But I believe we are transitioning into a more sober, realistic era for AI. Ironically, the very shareholders who fueled this initial frenzy might be the ones to bring an end to the current lunacy. CEOs who drastically downsized their workforce are now quietly expressing regret, a testament to the shifting landscape.